In this video, I'll be revealing the critical flaws that JP Morgan's research found, which causes many retirement plans to collapse, even when retirees think that they're financially prepared. I've worked with retirees for over 15 years, constructed hundreds of retirement plans, and I took a look at JP Morgan's data on retirement plan failures, which showed the timing of market ups and downs, not necessarily the volatility itself, can determine whether retirement plans fail or succeed. But there's a few things that I think they're missing, and that's what I'm going to show you here. If you're new to the channel, my name's Justin. I own a financial planning firm in Lewisburg, Pennsylvania, where we work with retirees all across the country, helping them make smart financial decisions and showing them where the flaws might be in retirement plans and helping them avoid that. That's exactly why I'm making today's video, to expose the sequence of returns flaw and others in JP Morgan's research, show you what they get right, what they're missing, and how to prevent your retirement plan from potentially becoming another collapse statistic. So let's get right into it. So first, let's address the sequence of returns flaw that JP Morgan identified and that I think a lot of people misunderstand. So when they talk about sequence of returns flaw, they're highlighting something that looks scary on paper, but surprises people in real life, because most people and financial calculators, including financial planning software, assumes that if your average return is good over the long term, then your retirement plan should work. But the potential threat isn't just ups and downs, it's the timing of those ups and downs, or that volatility, as we call it. And a big fear that's often emphasized in the financial industry is that sequence of returns risk, meaning a bad market in the first 5 to 7 years of retirement can do way more damage than that same downturn 20 years later. Just looking at two identical portfolios, $1 million, they're both taking 4% withdrawals adjusted annually, and they're getting the exact same investment returns, but in different orders. So if you have a portfolio on the top here with a good start, but a bad end, it can be drastically different from one at the bottom with a bad start, but a great end. So essentially, you take two identical portfolios with identical long-term returns, but end up with completely different outcomes, just simply because the order of the returns is different. And this is scary to a lot of people. JP Morgan is absolutely right about the mechanical reality of this, but here's the part that they never say out loud. This nightmare sequence is statistically very rare. A very interesting 2020 paper on sequence risk, is it really a big deal? Javier Estrada points out that it's a scary scenario, but one that evidence shows that retirees are not very likely to encounter. His research found that what leads to failure is the combination of early low returns and inflexible withdrawals, and portfolio depletion can obviously be avoided if retirees are able to lower their withdrawals in response to market declines. So you could actually look at it more of a sequence of withdrawal risk than sequence of returns risk. He goes on to say that the risk is real and investors should be aware of it. However, all the extreme examples that are used to illustrate sequence risk have never happened and have a negligible probability of ever happening. And here's the issue that I'm highlighting. So should advisors or planning industry resources highlight just the magnitude of this problem, but not reference its low probability of actually occurring? And he concludes by mentioning that he's not trying to downplay the relevance of it. What he's saying is that ignoring the low probability of this occurring can cause people to make suboptimal portfolio decisions, like being unnecessarily conservative just out of fear. And JP Morgan and other industry resources lean heavily on these examples because they look dramatic, not because it's common. Fear sells, draws a lot more attention. And this is actually something that I discuss with clients in meetings twice this week. When we build plans, we intentionally spend a lot of time looking at the pessimistic outcomes, worst case scenarios, because the biggest question in planning is, am I going to be okay? That's what everybody really wants to know once you cut through all the noise. And of course, you need to look at some of these outer edges so you know where the real risks live to answer that question. But you also can't lose sight of what's realistic, what the market usually does. If you look at history, bear markets are relatively short, bull markets are a lot longer. Most of the outcomes over time trends towards the positive, and we don't want to forget that. So the goal is balance. You can definitely be aware of rare negative sequences without structuring your entire retirement around the assumption that everything is going to go horribly wrong. And being too conservative can actually limit the very growth that you're going to need to support your long-term lifestyle. So good planning, realistic planning, prepares you for the worst without cutting you off from the potential benefits and that potential upside. And so how can you look at things and set your plan up with a lot more realistic assumptions then? Well, let's take a look at the stress testing flaws that can expose some of the planning inadequacies here. And JP Morgan found that most retirement plans use assumptions that makes everything look smoother than it really is. And I see this all the time. They'll use average returns or a lot of 401k website calculators. They use those straight line growth models that have never actually occurred in real life. And I can show you this in software. So if we open up software, I can run the default mode is the baseline, meaning just running a linear average return of, I think this is about 7.2, 7.3%. And it's just running in a linear fashion. It's just going straight up every year, no deviation. So when you get to the end, if you look at 15, 20, 25 years, your average return is going to be that 7.2 or 7.4, whatever it happens to be. However, that is not realistic. That's not the way that returns come in real life. So what I like to show is I want to show realistic returns. So I'm putting a recent 30-year scenario starting from the year 2001, so you can see what the market could actually do. Of course, we don't know future returns, but we're just modeling off a past here. So we have 2 negative years in a row here. And then of course, returns are random, which they're going to be. You have a 2008 type year. But the point is, I don't want to just see a flat return scenario. That doesn't really tell us anything. We want to see what happens year by year and see where we might need to make adjustments, what the psychological reaction might be. So this makes it a lot more realistic, and we can see where there might be some potential danger zones. And this reflects actual reality. And I think most DIY plans or generic calculators can skip this completely because averages are A, simple to use, and then B, they feel reassuring on a spreadsheet. But the real value of stress testing isn't fear, it's clarity. We want to get as realistic of an outcome as possible. You want to know where your plan's vulnerable before real life forces you to acknowledge where it's vulnerable. And now that I've shared a little bit of how the typical plan changes a little bit once we stress test it realistically, let me show you the one buffer that can neutralize some of the damage before that happens. So let's go over liquidity strategy that JP Morgan talks about, and I'll add my thoughts onto that. So JP Morgan recommends keeping about 2 to 5 years of spending in cash or secure investments like bonds. I totally agree here. The purpose is simple. When markets drop, you want to pull from those secure sources, whether it's cash, short-term bonds, instead of selling investments at depressed prices. This gives your equity or your stock side a chance to recover. And this allocation could be standalone. I know people who like to have what they call a war chest of cash, for example, or this could be built into your overall allocation, whether it's like 60-40, 70-30, for example. If you have using $1 million, to make the math easy, if you have a 70-30 portfolio, that's $300,000 in bonds, secure type investment. So if you're spending $50,000, for example, well, you have about 6 years of annual spending there to help you buffer against any type of market turbulence. And for many retirees, this liquidity sleeve is about as much emotional protection as financial protection. When you know that your next couple years are already funded, then you don't have to feel as much anxiety when the market's down 10, 15, 20%, for example. You can take that cash or draw from those secure sources that you set aside, not from the investment part. And I think this part is where a lot of investment models will get it wrong. So I'll see statements and models from large companies all the time that have withdrawals coming out for retirees pro rata, meaning from the entire portfolio. When the market drops, you want to make sure you're taking from the secure portion. Ideally, you don't want to be withdrawing from the entire portfolio and taking money off of the stock or equity side that's already depressed. So you want to make sure that your withdrawals are coming from the right spot. This is an area that a lot of people miss, but there is some nuance to having the cash portion. And a lot of people will mention 2 to 5 years as if everyone needs the same amount. In reality, some retirees need a lot less because of pensions or delayed Social Security. Others might need a lot more just due to higher spending, lower risk tolerance. So it's a starting point, not a universal law. And that's where I think it's important to have a lot more customization in there. But A proper liquidity setup reduces both timing, risk, and that emotional stress, giving your portfolio a lot more room to breathe when there's a lot of volatility going on. But having cash or a secure portion alone is not always enough. You still need a way to manage withdrawals so your plan bends during volatile times instead of it breaking. And while we're talking about stress testing, having cash on hand, if you have questions about your retirement or feel like you need some help, you don't want to do it all alone, click the link in the description below the video. It'll take you to a detailed video that I created that talks about my retirement process, what I like to focus on, how to incorporate things together, and a way to book some time to talk to me. If you have questions, if I can help, just let me know. So let's go into the dynamic withdrawal solution that can prevent potential plan collapse. And I love this part. I love talking about withdrawal strategies. I could go on, but I won't. I'll keep it focused here. Dynamic withdrawals are very key. This just means adjusting your spending slightly during downturns instead of sticking to one rigid number. And you can adjust it upwards as well during good times, but right now we're focusing just on the downturn part. And this is backed by lots and lots of research. I could put so much into the video, but again, I'll keep it specific. So many hear dynamic withdrawals though, and instinctively know that they should make some kind of adjustments at some point, but they just aren't sure what to do or how to actually do this. It feels really complex to them. So let me give you some quick examples. And so many people are familiar with a guardrails approach, and this was popularized in 2006. So what you do here is start with an initial withdrawal rate. So let's say, for example, starting anywhere from 4 to 6%. And then as the portfolio balance, if it increases to a certain point, you can increase withdrawals. If it decreases below a certain point, then you decrease and adjust your withdrawals. And looking at some quick math here, if the portfolio started with $1 million, initial withdrawal rate 5%, so $50,000 a year, that upper guardrail is if the portfolio jumps up to 1.25 million, then that would trigger a pay raise. If the portfolio fell to somewhere around 833,000, that would trigger a withdrawal decrease. So a pay raise could go up to, for example, maybe 55,000. A pay cut could drop you down to 45,000. And this approach can be key to make sure that you're not overspending when the market drops and that you have low probability of running out of money. There are some drawbacks to it though. So for example, if the market's extremely volatile, if we look at this approach in 2008, this would have required a retiree to cut their spending by about 30%. Now, some people could afford to do that. Some people can't. So these withdrawal strategies are all designed to be tailored to the person's specifics, sometimes to the psychology as well. So there's lots of different ways to do this. You could also use risk-based guardrails where you're doing this a little bit differently. So you don't have to have those potential dips as low as I just showed a second ago in the 2008 example. So again, there's a flavor here for everybody. So it really just depends on how well it's customized to you. And I think here's the part that JP Morgan research understates. So flexibility is often a lot more powerful than having a large cash reserve, for example. So adjusting spending solves more problems than just going the other route and building a bunker of cash that you might never touch or is just actually losing you money to inflation. So dynamic withdrawals give you control. You adjust, you protect your portfolio, you allow the recovery to work in your favor. And this is where things get interesting. So once you can adjust spending, the downturns that actually used to scare you can now work a little bit in your favor. And here's what I mean. I'll show you the opportunistic planning approach that can turn volatility into a little bit of an advantage. And JP Morgan here highlights something that seasoned planners already know. Volatility or those market ups and downs aren't always a threat. Sometimes it's the best opportunity to do things or the best opportunity that you'll ever get. And I call this turning lemons into lemonade whenever the market dips. We all know markets are going to fall sometimes. There's no way to avoid it or properly forecast it in advance. So when markets fall, certain opportunities become a lot more attractive. For example, Roth conversions can be a lot more attractive because you're converting at depressed values. And then when those assets recover inside the Roth, then that growth is appreciating tax-free. Market ups and downs also create other opportunities like tax loss harvesting. So for example, in non-retirement or brokerage accounts, you might have some positions that have loss. You could potentially capture that loss and use it to offset gains into the future. Or you can do what we call discipline rebalancing. So we can reposition, maybe if you're at a 70-30 and you want to rebalance to another allocation, maybe when the market drops, you can go to 75-25, 80-20. If you had decided that, hey, I want to take advantage of this, I've been meaning to restructure and add a little bit more risk, that's a great time to do that. So just an example of how repositioning with purpose can capture tax benefits, discounted shares, and I think these opportunities get missed quite a bit. JP Morgan tends to present all this like a simple checklist, but in reality, real opportunistic planning requires specific coordination between taxes, investments, income timing, long-term strategy. So the potential benefits here can be pretty big. And this is something I really like to focus on with clients during downturns. For example, in March, when we had the whole tariff scare, the market was down. We were able to do a lot of these strategies, create some opportunities. So instead of feeling helpless during downturns, we can have specific proactive steps that can turn volatility into long-term value. And that's what good planning does. And when you layer all this together, you get more than just a list of generic strategies in an article. You get an actual system that can help prevent potential retirement collapse. And here's what it looks like when we put all the pieces together. So let's take a look at a comprehensive framework that can prevent some of these flaws and some of these mistakes that we just finished talking about. And so when I'm bringing a plan together, I want to create a system for long-term retirement success, incorporating all these things together. So number one, you want to stress test using realistic sequences instead of just those smooth return numbers. We want to see real numbers year by year. We want to see those random returns. We want to see those potential years where things could drop quite a lot. We want to know how we're going to react psychologically if we need to make a spending adjustment. And then you want to run multiple scenarios too. Don't just run all the pessimistic ones. Run some where you're stretching spending. Also keep in mind, as I mentioned before, that most of the outcomes in the market are to the upside, to the positive. So don't just run all negative scenarios and without keeping that in mind. Number two, you want to build a liquidity reserve as well, so you're not forced to sell during downturns. Now, whether you have it separate, whether you have it as part of your overall mix, for example, like a 60-40, 70-30, or you just have a specific cash fund set aside, you want to have that there. And then you want to make sure you're withdrawing from that portion. As I mentioned before, if it's part of your overall allocation, make sure when the market drops, you're taking from that. For example, if you have a 70-30, take from that 30% secure portion. Don't draw from your stocks or equities during those market dips. And then number three, you want to use those dynamic withdrawals to protect your plan when the market gets rough. And this can be highly specific. It should be highly specific and tailored to you because there are a lot of dynamic withdrawal approaches that you could use. I've made videos about a whole bunch of different strategies before, but you want to make sure that that matches up to your lifestyle, your psychology, and it's a plan that you can stick to. And then lastly, use that opportunistic planning to turn market dips into long-term advantages. We don't just want to sit and do nothing at all. We want to see where we can take advantage of that and make that lemonade out of those lemons. And I think this is one of the big flaws in JP Morgan's research. They show all these ideas separately, but they only work when it's all coordinated together. So retirement planning is not like an a la carte menu. It should be a system where every decision affects the others and they're all synced and integrated together. And so now that you understand a little bit about why retirement plans can potentially collapse according to JP Morgan's research and how different risks like sequence of returns, inadequate stress testing, bad liquidity management could potentially create plan failures, you can implement some of the recommended protection framework to prevent your retirement plan from becoming a collapse statistic, because we definitely don't want to see that. If you want help in developing a comprehensive strategy, if you listened to a lot of this video and thought this is great, but I don't want to do all this myself, feel free to click the link in the description below the video. It'll take you to a page where I talk a little bit about my whole approach to retirement planning, how I like to integrate things, and you can book a call with me to see if we're a good fit to work together. If I can help, just let me know. Glad to do it. Thanks again for watching. As always, I appreciate it, and I will see you in the next one.